Hola, buenas tardes. Hacemos en español la sesión. You don't speak Spanish, though. I thought that we're in the university, we'd do some venture capital, some Spanish lessons. No, hi, it's great to be here with you, and thank you very much for being in this session. I know that there's a lot of content, and I hope you enjoy it. As Shmuel was saying, I'm a partner and managing partner of Leap Ventures, and I'll speak about developing the grit to get to greatness. And I think that when we think of venture capital and investing in technology companies, we've seen this chart several times, right? We know that the largest cap companies out there are private companies, and then on the other side, that we know that the best returns you can generate on investment in tech companies right now are from private investments. We all know that. We know that venture capital is interesting. We know that we want to get into it. We also know that when you look at a broader portfolio strategy and when you look at broader portfolio, you know that venture capital over-indexes in the terms of returns it can generate. That's something we know, and probably that's why we're all here. I mean, actually, as a question, who here has already invested in venture capital? So it's probably about half. Who is planning to invest in the next, I'd say, month or so? Okay. And the rest are just enjoying? Coming for the free food. And when they tell you, okay, so how do I invest in venture capital? How do I do my due diligence? So I'll show you a short clip on Billions, the TV series that's available on Netflix. Very good series if you like watching series. And I'll show you, I mean, yeah, I know you come, you go to the investor and you tell him like this.
Nothing about what you do is patentable or a unique user experience. You haven't identified an isolated market segment, haven't truly branded your concept. Do you need me to go on? So why would an investment bank put serious money into it? I all but told you ahead of time, but you wouldn't listen. Now you've heard it, but it's too late. You weren't ready.
So you come, you do diligence, you do it hard on the entrepreneur. I'm an entrepreneur myself, so I know how it feels. And but let's do a reality check, right? Everyone says, or some people say, hey, I want to invest in a company that will be 1 billion. I mean, I'm not particularly a fan of that, but I mean, the chances of becoming a $1 billion company, it's 1%. The failure rate in venture capital is 90%. The average years that companies stay private is 10.9%. So companies are staying private longer. How do we develop the grit to go along these companies and stay with them until they become good companies and can generate returns for us? And there are some common analogies which are pretty interesting. I mean, some people tell that investing in venture capital seems more like marriage. You know that the average timeline of a marriage in the US is 8.2 years. Venture capital, private companies is 10.9 years. They also tell it that it's like a Polaroid, right? Where you just take a snapshot on the company and then you have to trust and you have to understand who the investor is. And then you gotta understand that this is the company I want to put money on. But the ugly truth is that whenever you're investing in venture capital, it's gonna look much more like this. So what it's gonna look like is you're gonna be investing, you're gonna do some inflows, you're gonna invest capital, you'll see that the net asset value of your investment goes down. It will take a while until you start the harvesting period that you can generate and start generating returns. So what can you do about it? And the way we at Leap understand it, and this is something we didn't invent, this is something we took part of people, very, very smart people like Shmuel and the OurCrowd guys, part of the best venture capitalists in the world. The way we do it is as follows, and this is the way our thinking is. So deals can be wrong, and deals will go south, and deals will fail. What you cannot do is that you cannot miss on doing the right procedures in order to select what you want to invest on. And that's, in my opinion, the most important aspect on being able to invest in patient capital and long-term capital. You have to choose, and you have to make the right decisions and have the right framework to choose what at that moment seems to be a good deal. And what does that look like in terms of the best venture investors? So first of all, you have to understand the factors, right? You have to understand the factors. What are the success factors? So if you look at what are the top 5 success factors among 200 companies, timing, team and execution, team is very important, idea, business model, funding. And what are the failures? No market need. We see a lot of technologies that where there's no market need and they never find a market. Or they ran out of cash, they didn't have enough cash. So even though it sounded like a smart idea, it didn't have enough cash, it didn't raise enough money. Not the right team, get outcompeted, pricing or cost issues. They were talking about, Amir was talking about unit economics, the importance of unit economics. So if you understand the factors that make companies succeed or fail, at least when you do the investment, then you can tell yourself, okay, I don't know if this is going to succeed or not, but at least I made the right choice with the right information I had. And that will give you enough patience to wait until you start the harvesting period. Then investment criteria. This is our course framework as investment criteria. So you want to make sure that you invest in the right people. You want to make sure that you're tapping a large addressable market, not just market share. You want to make sure that there's a simple value proposition. If the company doesn't have a simple value proposition, it's probably not worth it. It's probably that it won't find a way to profitability. Differentiation. Is it different from the competitors? Is it different because it has IP? Is it different because it's a different business model? Traction. What is the traction? Not just in terms of commercial traction. Partners or potential partners. What about let's say, regulators. Is it working or is it not working? And what are the sponsors? So who is co-investing with us? That's also a very big part of choosing the right companies in order to generate long-term returns. Be empathetic. That's also very important. This looks like the life of an entrepreneur, right? So everything looks good, then everything goes out. And then the next day, everything looks good, and then everything goes out. So if you understand that it is part of the journey, and it's part of the entrepreneur's journey, instead of giving a hard time to the entrepreneur once things goes out, and you support the entrepreneur whenever you need to do so, that's very, very important. It'll give you more confidence that the entrepreneur can hold by when things goes out. Double down on breakout companies. We're talking about portfolio strategies. So if companies are performing well, don't keep it. We were talking about preemptive rights in the previous session. Don't keep it. If companies are doing well and performing well, that is the time when you have to double down on great companies, because that increases the chances of you getting an overall portfolio return. And then maximize the odds. You know that there's a very, very common saying in venture capital, which is the Vaporous Effect. So he's a guy who did a lot of home runs, but he also struck a lot. And when they asked him why you did it, so he said, okay, the way I do it is if I see the ball and I hit it as hard as I can and as strong as I can. Sometimes it will succeed, sometimes it will fail, but I do every time and I leave as big as I can, right? So failed investments, which usually come at the very beginning of the bad companies. I mean, if you're looking at a portfolio, you'll have the bad investments fail at the very beginning. Don't matter. What you want to focus on is the good companies you have. You have to invest on them, you have to work with them, and you have to make them succeed. Because at the end of the day, we have to understand how VC works. VC doesn't work on a normal distribution bell curve. VC works with a power law distribution, where 80% of the proceeds will come from 20% of the deals. So, and it looks more like this, like the J curve, where the performance of the portfolio at the beginning the net asset value of the portfolio will look negative, and then over time, the good companies will generate traction, but over time. So in our perspective, I mean, you want to build an overall portfolio strategy, but most importantly, you want to make sure that you made the right decisions at the time of investment. You want to make sure that you track the right KPIs. You want to make sure that to understand that companies sometimes have bad moments and sometimes have good moments, but if you have a broad enough portfolio and you follow, I mean, some of these principles or some of these key ideas, then you understand that in the long run, you can generate these type of returns. Thank you very much, and I don't know if we have time for a few questions.